Hey, what's up, guys? This is Indus here, the one-stop solution channel for your stock investment. We have business model, market analysis, and quarterly report summary provided for you in your investment decision. So, what did we bring this week?
Yeah, we've come with the company providing streaming service and TV devices, which is Roku.
Roku.
So basically, Roku is a TV streaming platform, or it's called OTT platform. It means that it provides the contents. I mean, it distributes contents to the viewers without involving any content providers. And they can be viewable. I mean, those contents can be viewable via the internet. So the company's founder is Anthony Wood, and he incorporated this company in 2002. And the reason the company's name is Roku is that Roku in Japanese, it means six. So Anthony Wood found this company as his sixth company.
Is Anthony Japanese?
I don't know. I don't know.
Just
Maybe he's a
curious.
big fan of Japanimation.
Okay.
I don't know.
He looks like American.
He's
He looks just-
yeah. Anyway, he found this company on the belief that Roku can be the central platform for TV ecosystem. And Roku, distinguishes its business segments into two. The first one is platform, and the revenues generated from advertising, content distribution, and various kinds of services are aggregated under this business segment. And the other segment is called player. What's unique about the Roku is that they also sell streaming players using consumer retail distribution channels such as Best Buy, Walmart, and Amazon.com. The reason they are doing this is, of course, to increase active accounts. So they also, manage average selling prices of these streaming players, and the prices range from $30 to $100 for each. And when we talk about the business model, their first step is that they constantly try to increase the number of active accounts using the Roku platform. As I mentioned in the previous slide, they sell standalone streaming players, and they also work with the TV brand companies such as Hisense, as you can see in the screenshot in the middle, and they sort of license Roku OS to set that OS into the TV and sell it to the consumers, and or they just reach out to certain satellite or telecommunications operators in other countries, so that the viewers in other countries can also access to Roku OS or Roku platform. And after gathering some amounts of the audience, they try to increase the user engagement and streaming hours they each spent on the platform. Of course, Roku they provide 500 or plus K channels under their platform, and they also run ads that are very relevant to each user, using their unique analytical
Data science.
database.
Data science.
Yeah. And finally, they monetize the user activity for their revenue and gross profit. They generate revenue from providing video advertising in ad supported channels, and they receive some fees from content providers by selling subscription services to the viewers, just like Netflix. And also they receive fees from providing brand sponsorship and promotions. As you can see in the screenshot, you'll see a Microsoft logo down. I mean, in the right corner, right hand side. Microsoft,
50-50,
yeah, 50/50 under 50/50 poster. They say it's sponsored by Microsoft Surface, and they receive some fees from Microsoft, and they also provide billing services to the content providers, so that those content providers gather the billing information easily. So the competitors for the Roku can be categorized as you can see in the slide. Some companies including Comcast or Android TV or YouTube or Google or even Samsung Electronics or LG Electronics can be competitors of Roku. Yeah.
Okay, going into market analysis, I wanted to look at content providers and TV sales and total addressable market for Roku. So first thing first, I checked US traditional TV usage. And as you can see, overall usage of traditional TV is decreasing. Mainly I think because traditional TV cannot meet the needs of each individual as they program their program. So it's reasonable. And if you're looking at global connected TV data, Roku is dominating the whole market, 44%. That's even combining Amazon, Apple, Xbox is still bigger. Roku is still bigger. So it means a lot for Roku. And a lot of people are using connected TV to watch those systems, 56%, versus mobile, 22%. According to the online community, I found that people prefer using TV or mobile device due to its screen size, and it's much easier to turn on the TV and do the multitasking. I don't believe in multitasking, but that's what they say. The global smart TV sales. This is something that shocked me because as a mobile user, I don't really watch TV. I don't think I have watched a single TV program this whole week. So I thought TV sales will decrease over time, but it seems that global market is actually holding up pretty well. And increasing smart TV sales will expand Roku's total addressable market, which is beneficial for Roku. Also, content provider is key for Roku because they are receiving advertisement revenue from those content providers. So I looked into Netflix and HBO's subscriber trend, and it seems that quarter over quarter active users are actually increasing, which is accelerated by coronavirus and pandemic shutdown, lockdown. So Netflix increasing, HBO Max increasing, Disney Plus is also increasing. So overall, the market for Roku is quite strong, promising. However, see, when I look at those data, I still believe that there are some trending changes over the longer horizon. According to those data, in 2020, mobile usage has surpassed TV usage in 2020, which I think is very interesting point to look at. And long-term shifts toward mobile from TV should be considered when investing in companies like Roku. Of course, as you saw in the global TV sales trend, it's not a short-term changes, but over the long run, I think one should consider how market will evolve as time goes by.
Yeah, so this is the Roku's 10Q summary of 2020 third quarter. Market capitalization of the company is $45 billion, and its location is in California, USA. 2020, 12 months revenue is 1.54 billion, which makes it a PSR ratio of 29 times or 30 or almost 30, which I think is a very high number.
It's a high number.
Stock movement, I mean, it started, I don't know, at like 26, and then now it's $356. If you look at the balance sheet, it has like the total asset of $2 billion and $1.5 billion are in almost cash. I mean, $1 billion is in cash. But I'm going to mention it later that almost 50 or 60% of the cash actually was raised through loans and at the market offering by Morgan Stanley. So they basically what they're doing is that they raise money from the capital market and then they are now expanding or they are planning to utilize the capital to expand to other countries. As for the current liabilities, they only have like $0.4 billion worth of current liability, and most of them are in the account payable, which I think it's not even much of a problem because they something that they are going to receive like account receivable is almost close to account payable. So I mean, you can see that the liquidity issue is not much of a problem for this company. As for the long-term liability, yes, this company has some debts, but it's not that much of a debt. I mean, if you look at the long-term debt, it's almost like 1 billion or like $91 million. So it's not even a whole lot. I mean, operating list liability is where you should focus on for this company because it doesn't mean that it has the debt. It means it's expanding its headquarters to different countries. So yeah, I think that this company doesn't seem to have that much of a problem with the liability. Income statement wise, yes, it's distinguished into two different category of platform revenue and player revenue. I'm gonna mention it later. This company actually turned into plus net income plus for this quarter. If you look at down below, 12 million is a small number, but still they managed to make now positive money flow for the company. Revenue and profitability aspect of this company, as I mentioned, the revenue growth is really strong for this company because of I think pandemic. 65% growth for the platform revenue, 40% for the player revenue. Gross profit margin is a lot better for platform, being that it is 60% gross profit margin, compared to player gross profit margin at 15%. Player with the platform revenue that has the like 10% or more revenue.
H school gang.
The client H. I'm sorry, I didn't. Client H at the 16%. Player revenue, they have three customers that account for more than 10% of the total revenue, which is ABC. I think it's Walmart, Amazon, and Best Buy at 11, 16, and 39%. Player manufacturing part is outsourced to other country. I think due to COVID-19, they actually mentioned that a lot of users are coming from conventional TV or transferring to conventional TV to streaming TV because now that more and more people are staying at their house and they are watching more TV hours, and this is beneficial for basically Roku. They have something called "Are you still watching?" function for their advisors. So basically, there are some people who sleep while the TV's on, and it doesn't mean they actually watch the thing. So they from time and on, I guess they have like this. Are you still watching? Sort of a logo on or message on, and you have to confirm it to really provide to their advertisers or their social revenue people, because they want to make sure that our users are actually watching this many hours, and this is you should pay more advertisement fee. They're expanding to Canada, UK, France, Ireland, Mexico, Brazil, and Latin America, and they're planning on doing this. They're just at the very beginning part of their expansion. So as for the debt and equity portion, they raised $96 million from Term Loan A, and then they also raised the capital in form of at the market offering at $504 million. Both of them are through Morgan Stanley. The Class A share has been transferred to Class B, converted to Class B before IPO, and as for the stock options and new issuance stocks, it's issued at the Class A. So basically, those people who used to own this company before IPO, they have better control of the company because they have Class B, which has 10 votes of the decision, compared to 1 vote for Class A. So this is why founder only owns 14%, but he gets to basically control the company in terms of decision making. From this funding, whether it's debt or equity, it is expected to really expand to different countries or setting up new headquarters and hiring new people. I think potential M&A is possible, and they're actually buying equipment as well. And they also did partial redemption of the debt with ATM or at the market offering. Risk, player is outsourced mostly, so I'm not really sure about the technological sort of a barrier for other people to compete. I mean, if they can outsource to other manufacturing parts, certainly other companies can get involved and compete with this company. Streaming TV growth sustainability is another issue, I think. I'm not really sure about streaming TV. I'm not aware of any of the market analysis. So yeah, and the competitor are very strong player like Amazon, Apple, and Google. I think Pixel issue is one of the things that I think they wanted to mention. They're paying less tax in the United States, they're paying more tax outside of the country because I think with the lower tax rate, like in Ireland or whatever. So eventually this could actually become the issue. Expansion, would it be successful in Canada, UK, Latin America? I think that time will tell, I guess. Currently, it's at very high PSR. It has very high PSR ratio, so I think it might be expensive. But if the growth can be sustained at current level, like 50%, then the current price is not even an expensive price. Sustainable growth. I mean, work from home. If it continues into the future, I think this is positive for the company. If you think that it's going to end anytime soon, well, then it will decrease the number of users and decrease the number of hours for watching Roku channel. So you have to make the decision. But still, there's risk. Analyst rating by Wall Street, an average price for this company is $275. Current price is $356. So I think it's very expensive. But yeah, you should actually make the decision on your own. But this is what the rating is. So yeah, so this is it for my part. So yeah, thank you for watching, and please subscribe to our channel.
Yeah, and press like button.
Please like button.
Yeah, thank you.
Thank you.
See you next week.